Hey there, fellow investors. Ever wondered how some people consistently pick winning stocks? Want to be in the know? It's like finding hidden treasure, but instead of digging in the dirt, we're diving deep into the world of finance. I'm talking about fundamental analysis, the secret sauce to making smart investment decisions. Think of it like this. Before you buy a car, you check its engine, mileage, and overall condition, right? Fundamental analysis is the same idea, but for companies. We're looking under the hood, examining their financial statements, and figuring out if they're a worthy investment. Now, I know what you might be thinking. Financial statements? Ratios? Sounds complicated. Don't worry, I've got your back. We'll break it down step by step using simple language and relatable examples. By the end of this journey, you'll be equipped with the knowledge to analyze companies like a pro. So buckle up and get ready to explore the exciting world of fundamental analysis. Together, we'll uncover the secrets to making informed investment decisions and potentially boosting your portfolio. Let's dive in. All right, let's cut to the chase. Fundamental analysis is all about determining the intrinsic value of a company. We're talking about looking beyond the daily stock price swings and understanding the true worth of a business. It's like this. Imagine a company that makes the best pizza in town. Everyone loves it, but for some reason the stock price is down. Fundamental analysis helps you understand if the stock is undervalued, like finding a hidden gem in a dusty attic. Why is this so important? Because by understanding a company's financial health, you can make more informed investment decisions. You'll be able to spot undervalued companies with strong growth potential, avoiding those that might be headed for trouble. Remember, investing is a marathon, not a sprint. Fundamental analysis is your trusty compass, guiding you towards long-term success in the stock market. Now let's get down to the nitty-gritty financial statements. These documents are like a company's report card, revealing its financial performance and position. Don't worry, we're not aiming for an accounting degree here, just a basic understanding. First up, we have the income statement. This bad boy shows how much money a company made, revenue, and how much it spent expenses over a period of time. It's like checking your bank account at the end of the month to see if you're in the green or red. Next, we have the balance sheet. This statement provides a snapshot of a company's assets, what it owns, liabilities, what it owes, and equity, what's left for the owners, at a specific point in time. It's like taking inventory of your possessions and debts to see your net worth. Last but not least, we have the cash flow statement. This statement tracks the movement of cash both in and out of a company. It's like keeping a record of every dollar that comes in and goes out of your wallet. Now that we've got a handle on the main financial statements, let's talk about ratios. These handy tools help us make sense of the numbers and compare companies within the same industry. One of the most popular ratios is the price to earnings, PE ratio. This tells us how much investors are willing to pay for every dollar of a company's earnings. A high PE could mean the stock is overvalued, while a low PE might indicate an undervalued opportunity. Then we have the price/earnings to growth PEG ratio. This metric factors in a company's earnings growth rate, providing a more comprehensive view of its valuation. A PEG ratio below 1 could suggest the stock is undervalued. Another important ratio is the debt-to-equity ratio, which measures a company's financial leverage. High debt can be risky, so a lower ratio is generally preferred. Remember, ratios are just one piece of the puzzle. It's crucial to consider other factors like industry trends, management quality, and overall market conditions. Section 5. Assessing financial health. Spotting red flags and green lights. All right, now comes the fun part. Putting it all together to evaluate a company's financial health. We're looking for red flags that might signal trouble and green lights that indicate a solid investment. Red flags could include declining revenue, shrinking profit margins, high debt levels, and poor cash flow. These warning signs might indicate a company is struggling to stay afloat. On the flip side, green lights could include consistent revenue growth, strong profit margins, low debt, and healthy cash flow. These positive signals suggest a company is on solid financial footing and well-positioned for future growth. Remember, it's all about context. What's considered a red flag for one industry might be perfectly normal for another. It's essential to compare companies within the same sector and consider their specific circumstances. Section 6. Practical applications. Putting knowledge into action. Now that you're armed with the basics of fundamental analysis, let's see how it works in practice. Imagine you're considering investing in a company that makes electric scooters. First, you dive into their financial statements. Is their revenue growing as more people adopt eco-friendly transportation? Are they profitable? Or are they burning through cash? What's their debt level like? Next, you'd calculate key ratios. How does their PE ratio compare to competitors? Is their PEG ratio indicating potential undervaluation? Is their debt-to-equity ratio manageable? By analyzing this information, you can make a more informed decision about whether to invest in the electric scooter company. Remember, knowledge is power. Section 7, the power of fundamental analysis, real-world success stories. Don't just take my word for it. Countless investors have achieved remarkable success by mastering fundamental analysis. Warren Buffett, one of the most successful investors of all time, is a prime example. Buffett's investment philosophy centers around identifying undervalued companies with strong fundamentals and holding them for the long term. His incredible track record speaks for itself. Another inspiring example is Peter Lynch, a legendary fund manager known for his remarkable returns. Lynch believed in investing in what you know, emphasizing the importance of understanding the businesses you invest in. These investors demonstrate that with dedication and a solid understanding of fundamental analysis, it's possible to achieve significant success in the stock market. Section 8, your journey to financial mastery. Embracing the fundamentals. Congratulations, you've now embarked on your journey to financial mastery. By embracing the principles of fundamental analysis, you're equipping yourself with the tools to make smarter, more informed investment decisions. Remember, learning is a continuous process. Keep exploring, keep asking questions, and never stop seeking knowledge. The more you understand about fundamental analysis, the more confident you'll become in your investment journey. So go out there, put your newfound knowledge into practice, and start analyzing companies like a pro. Your future self will thank you for it.